One quiet decision in your first year of business can lock you out of thousands of dollars in vehicle deductions for as long as you own your car. Most new founders have no idea the rule exists until it is too late to fix. If you drive for your business at all, the IRS gives you two completely different ways to deduct that cost, and the method you pick in year one determines which options stay open later. In this video, I will break down both methods, the first-year trap, what actually counts as a business mile, and the one record that protects the whole deduction. Quick note before we start, this is general education, not tax advice, so run your specific numbers past a CPA. Method 1 is the standard mileage rate. You track every business mile you drive and multiply by a per mile rate the IRS sets, currently around 70 cents per mile, a figure they adjust each year. Method 2 is the actual expense method. You add up everything the car really costs you: gas, insurance, repairs, tires, registration, and depreciation, then deduct the percentage of those costs that matches your business use. Same car, same driving, but the two methods can produce very different deductions depending on your situation. Standard mileage tends to win when you drive a lot of miles in a fuel-efficient, reliable, or older paid-off car. The math is simple. 10,000 business miles at roughly 70 cents is about a $7,000 deduction, with almost no receipt tracking beyond the mileage log itself. It is also the low-stress option for new founders because there is nothing to allocate and very little to get wrong. On top of the rate, you can still separately deduct business parking fees and tolls, which many people forget. The actual expense method tends to win with newer, more expensive vehicles, heavy fuel costs, or big repair years, because depreciation on a pricey car can dwarf the mileage rate. Here is how it works. If 60% of your total miles were business miles, you deduct 60% of every car expense. That means keeping receipts for gas, oil changes, insurance, repairs, lease payments, or depreciation all year long. More paperwork, but for some vehicles the deduction is dramatically larger, especially in the early years of ownership. Now the rule that catches people. If you own the car, you must choose standard mileage in the first year you use that car for business if you ever want to use it. Start with actual expenses in year one, and standard mileage is off the table for that vehicle permanently. Choose standard mileage first, and you keep the flexibility to switch to actual expenses later, with some depreciation limits. Leased cars are stricter. Pick standard mileage and you must keep it for the entire lease. When in doubt in year one, starting with standard mileage preserves your options. Not every mile counts, and this is where audits get ugly. Driving from home to a regular workplace is commuting, and commuting is never deductible. What does count? Trips to see clients, supply runs, drives between job sites, trips to the bank or post office for the business, and travel to temporary work locations. One powerful detail: if your home qualifies as your principal place of business, trips from home to business stops generally become deductible business miles, because there is no commute to subtract. Whichever method you choose, the deduction lives or dies on your mileage log. The IRS expects contemporaneous records, meaning kept as you go, not reconstructed in April from memory. Each entry needs the date where you went, the business purpose, and the miles. A cheap mileage tracking app on your phone handles this automatically in the background, and a simple notebook works too. In an audit, a clean log is the difference between keeping a 5-figure deduction and losing all of it. Quick recap, you have two methods: standard mileage, simple and around 70 cents per business mile, or actual expenses, more paperwork but potentially bigger on newer cars. The first year choice matters because skipping standard mileage in year one locks you out of it for that owned vehicle. Commuting never counts, client and business trips do, and a contemporaneous mileage log protects everything. This is education, not tax advice, so confirm your method with a CPA before filing. If this saved you from the first-year trap, subscribe to Founder Filing for more plain English guides, and grab the free resources linked in the description.